Hey there. So, in today's video, we'll cover up trading psychology and the most common mistakes that people make, which is related to this trading psychology. So, first of all, you have to realize that trading is actually just 30% theoretical knowledge and whatever it is, and the rest 70% is actually just your psychology. By psychology, you mean how your emotions actually affect your trades. So, we'll go by these mistakes one by one to understand how each emotion will actually drive you into bad trades. The first emotion would be fear. The most common mistake that a lot of people do is the fear of missing out, which is also called FOMO trading. So, what is FOMO trading? FOMO trading usually occurs when there is actually a sudden spike in the market, or if you have already missed your entry point. At this point of time, your brain is going to start playing with games with you. You would have your trade setups ready and you would already know that this is the right way to do it, but because you see a sudden spike or sudden activity in the market, you have this feeling from all of a sudden from anywhere that this could be the one trade that I have to take. Now, within few seconds of time, your brain is going to convince you that this has to be the trade that you have to take. Now, this happens in a very small amount of time. Your trade setups will be telling you not to take this trade. Your brain will actually tell you like you should probably not take this trade, but because of an impulsive reaction in the brain, you would definitely end up taking that trade. So this is what leads to a loss for a lot of people. And you will also have this feeling that I can't miss out on this trade, I will never get this opportunity again. But trust me, that's not true. You will find countless amount of opportunities in the markets every single day for the rest of your life. It's always better to not trade than just trade impulsively on a random fear of missing out trade. So another factor that actually influences FOMO trading is actually the people around you. So when you hear people making an X amount of cash while trading, even you will be affected because of this. For example, let's say this guy over here, let's say he says that I've just made rupees 6,756 on HDFC Bank. And the other guy says, I took that trade too and made rupees 12,456, right? And you would be there trying to find trades and you're not able to find trades, right? And you will feel frustrated that, okay, these guys are actually making money, but I can't even find any trade to trade on. And because of this, you will actually end up impulsively trading. You will trade on some random movements in the markets and eventually end up losing money. So this is also something that you have to make sure that you avoid. The next common mistake that everyone does is revenge trading. So what is revenge trading? As the name suggests, revenge trading means trying to take revenge on a particular trade. In the sense, if you lose some money while trading, and you will have this feeling that I have to somehow make back my losses. Because of this, you will end up impulsively trading into random stocks, trying to make the money back, but eventually you will just end up losing more money, which is not good for you. When you're revenge trading, you do not really focus on the logic behind a particular trade. Instead, you let your emotions get the best out of you, which is not how it's supposed to be done. You have to make sure that you stick to the logic involved and do not let your emotions get in control. Now, the third thing we'll talk about is the gambler's fallacy. Now, to understand this, let's take an example of flipping a coin. Let's say for the past 5 times we flipped the coin, the outcome was heads. Now, what is the probable 6th outcome? If you think that the 6th outcome is going to be a heads again, because the past 5 times heads already appeared and the 6th is also likely to be a heads, or if you think the next outcome is going to be a tails because heads had appeared too many times already, it's about time a tails came, then you have fallen prey to the gambler's fallacy. What you should understand is that each outcome is independent of the other. This means that irrespective of what the previous outcomes were, was it a head or tails, it should not matter for your future prediction or your future outcome. But how do you actually avoid gambler's fallacy? It's easy theoretically, but what matters is practice. You have to practice and practice to get yourself more aware that you are falling for the gambler's fallacy. Now, this applies to trading as well. You should not let your past trades affect your present trade. You should consider each trade independent of the other. So the next time you take a trade, take a few seconds break before you actually get into that trade to just check and be aware if you're actually falling for the gambler's fallacy or not. Now, trading is actually not meant for the emotionally weak. By this, it doesn't mean that emotionally weak people cannot trade. All you have to do is you just have to keep practicing and keep and get a hold of your emotions. You have to realize that your brain is your worst enemy. Your emotions is going to affect your trades the most. So a journey of a trader is going to be you mastering your emotions, which is going to reflect on your profit sheets a lot.